should your clients be buying the dip in tech after the sell-off we saw yesterday and the ongoing dip we're seeing in European defense names?
Yeah, so we lean still in on the bullish side when it comes to AI. I'm not going to lie on that. Growth assets, long duration assets, they tend to like Fed cutting interest rates. We think they're going to do the same this time around. When we look at technology, it's still the sector that we expect to see very close to a 20% earnings growth from this year, outpacing by far most of the other sectors that we are covering. It's very clear at the moment. It is a little bit of an uncertain time just because we have Jackson Hole coming up with that very important sort of rate setting guidance. We also have NVIDIA coming up next week as well. So that's a little bit of an uncertainty at a time where valuations seem to be on the stretch side. So no, we still like it, guys, to come to the conclusion here.
Okay. You say, as you say, long duration assets, they respond to what happens at interest rates. That's fine. Short-end yields are potentially going to go lower if the Fed does cut, and you're right on that front. But long-end yields are doing the exact opposite right now, Mark. The curve is steepening. I've got a US 30-year that's north of 5%. I've got a US 10-year that's pushing higher as well in terms of the yield. Shouldn't that be a negative for tech stocks?
That would be a negative for tech stocks. So what we're expecting is that the long end of the curve will start to come down as we start to see those cuts coming in as well. So if we look at something at the US 10-year point, which is currently yielding at around 4.3%, we expect that to come down to around 4%. We expect the 30-year to rally from current levels close to 5% as well. So we think that there is an opportunity here in tech names, both from the sort of the cutting cycle, but also earnings that are still well on track. I think what is happening with sort of this unhinging of the long end of the curve is certainly uncertainty around inflation expectations. Again, we saw these producer prices coming up. Inflation expectations in the Michigan survey were sort of moving upwards again. Stephen Moran coming in on the Fed eventually. This Fed independent story is something that makes markets a bit nervous, but I don't think it's going to change sort of the overall course of the Fed. And ultimately, we think that long end yields are going to be driven by the short end as we usually see.
And Mark, how are you disaggregating the tech sector in the United States right now? Because, of course, there's the likes of NVIDIA and those that have led the AI enthusiasm trade. And then there are those you might deem to be AI laggards, but still exposed to that trend. How are you separating the two, and over what kind of timeframes?
That's a good question. So we've very much, in this early phase over the last 1-2 years, focused very much on the enablers, so be it sort of the chip makers and the like. At the moment, we tend to focus a bit in around some of the more defensive names with sort of more stable earnings growth. I think as we're moving out over the next 1 to 2 years, we're going to see more of the sort of applications or the usage of AI that's going to be exciting. So I think this is a journey that has started where we're still in the early innings of this game. So when we look at the surveys that are being conducted within US firms, how many have really adopted AI? We're not even at 10% yet. So I think, again, we're in the very early days. There's still a long game to be played, and we're trying to stay on top of this as one of our core investment themes that we guide our clients towards in our multi-asset portfolios is something that we continue to like.